Well, hello everyone, and welcome to this Amber and BGA Impact Trailblazer focused on regulatory risk, vertical integration, and upstream investment. My name is David Woods-Hale, and I'm Director of Marketing and Communications at Amber and BGA. And today I'm delighted to be joined by Dr. Dongyu Guo, Assistant Professor at NUCB Business School, to take us through the topic. Shortly, I'll hand over to our speaker to take us through this theme today. But just before I do, just to remind you, there's a question panel on your control panel. If you have any questions at all that you'd like us to look at towards the end of the webinar, we can absolutely do that. So just pop your questions and we'll try and get through as many as we can towards the end. So without further ado, I'll hand over to Dr. Guo to take over the session. Thank you very much.
Thanks. Hello, everybody. Thanks for attending my presentation. So today I would like to present my latest published paper, Regulatory Risk, Vertical Integration, and Upstream Investment. This is a joint work together with my co-author, Raffaele Fialco. So today I would like to first provide the motivation of the paper. Then I will introduce the basic structures of the model. After that, I will show the main results. Of course, I will focus on the rationale behind the results. And at the very end, I will include. Okay, so now let's start formally. So vertically related markets are well known in several industries. For example, electricity, gas, railway, telecommunications, and water network industries. Our setting is one upstream regulated form provides the essential infrastructure facility to the downstream forms. But besides providing the facility, the upstream form can also decide whether to invest or not. For example, we can consider the broadband infrastructure in telecommunications industry. The aims of upstream investment can be, for example, to reduce operation costs or to improve the quality of existing services or existing products, or to provide new services or new products. So the upstream investment typically enhance the downstream form's profits and consumer surplus. Meanwhile, upstream investments are generally unobservable by the regulator, and the investment process is irreversible. So the regulator would like to incentivize the upstream regulated form to provide high effort on investments. The upstream form's investment incentives are affected by two elements. The first element is the vertical industry structure. What does it mean? It means under vertical separation, the upstream form only provides the essential facility, while under vertical integration, the upstream form will also compete directly in the downstream market. Because the essential facility exhibits the feature of nature monopoly, the upstream form that controls the facility is usually subjected to regulatory intervention. Therefore, the regulatory structure also plays a role on investment incentives. The uncertainty about future regulatory policies is known as regulatory risk, which is one of the main business risks for firms. The regulatory risks have been explicitly recognized in the law and business world. They are determined fundamentally by legal and institutional environments. They appear with different reasons. For example, regulatory risk is affected by the timing of regulatory reviews. The typical lifetime of an investment asset in infrastructure industries is much longer than the regulatory review period, which leads to the risk of future regulatory disallowances of investment costs. Moreover, some regulatory regimes explicitly incorporate flexibility in the regulatory hearing dates. And the legal provisions about the investment cost recovery translate into different levels of regulatory risk. If the regulator uses the replacement cost, it means the regulator calculates the incurred cost based on the latest technology. It means it doesn't mean that the firms really use the latest, the cheapest technology. They might use the more expensive technology, but when the regulator calculates the cost, they use the latest technology, which means in this case, the firms suffer higher risks. Okay, but if the regulator uses historical costs, it just means that the regulator calculates the firm's actually incurred costs. The thing is that in the US and German, the telecommunications industry, the replacement cost, which means the higher risk regulation, are widely applied. So this is clear that this particular type of regulatory risk is associated with the uncertainty about technological progress. Okay? And then there are also other reasons can induce regulatory risks. So in our paper, we investigate the impact of regulatory risk on vertical integration and upstream investment incentives. We find that under some conditions, some degree of regulatory risk is ex ante socially beneficial, especially when the upstream regulated firm is madly risk averse, which is counterintuitive because I don't know about you, but before I saw this model, we thought that the firms always prefer the very stable regulatory policies. Okay, and our results are related to two groups of literature. One group is about the social benefits of regulatory risk in a standard optimal monopoly regulatory setting, and another group is about the social benefits of partial commitment in debt contracts and of legal uncertainty. Now, let's look at the upstream market first. The upstream firm provides an effort which can be high, EH, or low, EL. The effort is unobservable, so this is a model hazard problem, which means the regulator would like to incentivize the upstream firm to provide high effort. The cost of effort depends on the effort's level. We normalize the cost of low effort to 0 and define the cost of high effort as positive. The investment outcome K is observable, and it can be successful S or failed F. The successful outcome can be interpreted as reduce the price or improve quality of the input provided to downstream firms. This definition just shows that if the upstream firm provides high effort, the probability that the outcome is successful is higher than the case when effort is low. Okay, except all these assumptions, we do not use any restrictive assumptions. And you can imagine the upstream firm would like to maximize its utility. It receives transfers determined by the regulator, which depends on the observable investment outcome. If the investment is successful, the upstream firm will get T upper bar. Otherwise, it will get T lower bar. In line with regulatory practices in most of countries, the upstream firm is protected by limited liability that ensures non-negative payoffs. Because the cost of low effort here is 0, The limited liability constraint here is T is non-negative. And we use a concave utility function to capture the form's degree of risk aversion. Actually, risk aversion is a quite standard assumption in model hazard environments. We can imagine that the forms are risk worse because of costly bankruptcy, costly financial distress, or imperfect risk management, or nonlinear tax systems. Okay. Now let's go to the downstream market. So there are asymmetric competitive forms. The downstream forms get higher payoffs pi upper bar when the upstream investment is successful. Otherwise, they will get lower payoffs pi lower bar. Because also the upstream forms, they enjoy the successful upstream investment. Please notice that the ranking pi upper bar is larger than pi lower bar holds under any type of competition, as long as the competition generates positive payoffs. Here, we assume that all the forms have the same risk preferences because we use the same concave utility. Actually, we only need some degree of risk aversion of the upstream form for our main results to hold. But a setting that allows for different risk preferences would make the analysis less transparent without providing any useful additional insight. The upstream form may decide to vertically integrate with one downstream form. If they do not integrate, which means under vertical separation, then the aggregate utility is the sum of the utility of these two forms. And under vertical integration, the new form receives the transfer T still from the upstream regulated activities and pi payoff from the downstream competitive activities. The social welfare is the difference between the gross surplus from the investment and the transfer. The most natural interpretation for S is the consumer surplus from buying the good in the downstream market. The successful investment induces higher gross surplus as upper bar, okay? And of course, as lower bar means this is gross consumer surplus with the failed investment. And the idea is that, again, the consumers benefit from lower final prices or higher quality of the product driven by a successful investment. And variable alpha is between 0 and 1, is a probability that the regulatory policy is enforced. We use alpha as a measure of regulatory risks. The smaller alpha is, the higher degree of regulatory risks. 1 minus alpha is the probability that the regulator revises the policy and offers a new sequentially optimal policy. Please notice that if the regulator revises the policy, it will do so only after the investment effort is given, which means this is a hold-up problem. When alpha is 1, regulatory policy does not change, or say the regulator provides a full commitment. When alpha is 0, then there is no commitment. Please notice that if the form is risk neutral, then it will ask the same expected transfer independent on alpha. It is indifferent to any degree of regulatory risk. However, a risk-averse form will ask for larger expected transfer when alpha is smaller. because the transfer is 0 with probability 1 minus alpha, the transfer provided with probability alpha must increase when alpha becomes smaller in order to ensure a given expected value. This implies that for a given mean, the variance of transfer decreases with alpha. The mean perceiving spread distribution of transfers associated with a lower alpha aggravates the risk carried by the form. And this formulation of regulatory risk reflects regulatory uncertainty about regulators' commitment powers and is in line with some relevant literatures. Okay, about the timing of the game, let me first read the timing and after I will explain some points. Okay, so stage 1, the regulatory structure is determined, which means the value of alpha is determined. Stage 2, the upstream regulated form decides whether to vertically integrate with one downstream form or not. Stage 3, the regulator makes an offer of the regulatory policy to the upstream form, which can be accepted or rejected. If the offer is rejected, the game is over. And if the offer is accepted, the upstream form provides an unobservable effort and the investment outcome is realized. Stage 4, the regulatory contract is enforced with probability alpha. With complementary probability 1 minus alpha, the regulator makes a new offer, which can be either rejected or accepted by the upstream form. At the very end, downstream competition takes place. Okay, so here I would like to emphasize 2 points. First, the regulatory structure alpha is determined by legal and institutional environment, and we would like to find the optimal alpha. Okay. Second, here you can see that the vertical integration is proposed earlier than regulatory policy offered. This is because, in line with the main literature and the regulatory practices worldwide, any regulatory policy cannot be made based on the vertical industry structure. The idea is, first, vertical integration is a long-lasting decision, while regulatory policy is relatively short. Second, generally speaking, the assessment of a merger proposal is delegated to the antitrust authority, which is not allowed to design any monetary incentive mechanism that induces a particular industry structure. Okay, and the equilibrium concept is subgame perfect Nash equilibrium, and we solve the problem by backward induction. Okay, the lemma 1. The lemma 1 actually tells us that when the cost of high effort is significantly small, a vertically integrated form will provide high effort with 0 upstream transfers, because the Model-Huther problem can be removed via vertical integration. And actually, this result is not interesting at all for us. So in the following part, we consider the situations that the cost of high effort is not significantly small. Okay, now let's begin with the case of full commitment, which means there is no regulatory risk. I summarized the proposition 1 into a table, so don't worry. And before I explain the rationale behind the proposition 1, I would like to explain some important notations. If you can see my mouse, then this one, it means with full commitment, the expected upstream transfer under vertical integration. And this one means with full commitment, the expected upstream transfer under vertical separation. And the delta nu times delta S is the expected social welfare gain from high effort. Okay, now I will explain the case by case. So the first case simply shows that the vertical separation pumps up and high investment effort is provided if the expected transfer under vertical separation is lower than the expected social welfare gain from high effort. This occurs when the cost of effort is relatively low with respect to social welfare gain. Okay, please notice that this outcome in this case holds independently on the value of expected transfer under vertical integration. Okay, to understand the rationale of this result, we consider 3 subcases. So in the first subcase, anyway, high effort is promoted. Why? It's because the cost lower than the gains. Okay, anticipating the high effort is incentivized regardless of vertical industry structure. And here, please also pay attention. The transfer is lower under vertical integration. So the firms find vertical separation more attractive. Okay. Now let's look at the second subcase. Again, the high effort is promoted because, again, the costs are lower than the gains. Differently from the first subcase, in the second subcase, if the high effort is induced under vertical integration, the internalization of the downstream payoff elevates the model hazard problem, which provides a vertically integrated form with lower expected utility. Please remember that the firms, they would like to maximize their utility, not maximize the transfer. Okay. So then, so I think this subcase is mainly related to some calculational result. So even though the transfer is higher under vertical integration, but actually the expected utility is lower under vertical integration. This is why also in the second subcase, the firms would like to stay vertically separated. Okay. And in the last subcase, I think this more transparent than the second subcase is that the expected transfer under vertical integration is too high to be compensated. So if the high effort is provided, the vertical integration is not feasible. Therefore, the firms will keep vertical separation. Okay. So this is all the 3 possible subcases under the case 1. Now let's look at the case 2. The second case shows that vertical integration takes place and high effort is provided as long as the expected transfer under vertical integration is lower, but expected transfer under vertical separation is higher than the expected social welfare gain. Okay, the upstream form anticipates that the regulator will induce high effort under vertical integration and low effort under vertical separation. This makes vertical integration profitable and stimulates high effort at a lower social cost. The last case applies that when the cost of effort is so large that the low effort is socially desirable independent on the vertical industry structure. Because the low effort implies zero transfers, we obtain that the firm and the regulator are indifferent to the vertical industry structures. Okay. Now we will turn to the situation with regulatory risks, but don't worry. Again, I summarize the proposition 2 and proposition 3 into a table. But here, I would like to only focus on the most interesting case, the red case, case 1, because if we look at this column, regulatory regime, this is a unique case that the optimal alpha cannot be 1, okay? Which means this is a unique case that full commitment cannot be optimal, which is counterintuitive. Actually, if we focus these two conditions, they are equivalent to the conditions of the fourth subcase in case 1 with full commitment. But compared to the previous result, okay, the high investment is still provided, okay, but the industry structure is vertical integration instead of vertical separation. So this is a difference. And why it can happen? Because now if the form provides a high effort, actually this upstream form now faces 2 types of risks. First, the form still does not know the realization of the investment outcome as before. They only know the probability, okay? In addition, the regulatory policy may be revised after the cost of investment effort has been incurred. Remember that the upstream form is risk averse. With regulatory risk, the regulator has to pay a higher transfer to the upstream form because of a risk premium, which means under form's risk aversion, regulatory risk mitigates the social desirability of high investment effort. Okay, but there exists a range of alpha where high effort is still socially beneficial, but only under vertical integration, not under vertical separation. Anticipating this, the forms find vertical integration more attractive, and this is why, in this case, the vertical integration takes place. The rationale behind this result is the vertically integrated form can internalize the downstream payoffs. This can mitigate the model hazard problem and stimulates investment at a lower social cost. I would like to explain this result with a figure, and I hope it's more transparent. Okay, so now let's consider alpha between alpha prime and alpha star. Okay, at this particular range, we can see from the figure the high effort is still the high effort is still socially beneficial under vertical integration. Why? Because this curve is below the delta nu times delta s, but not under vertical separation because this curve is above delta nu times delta s. Okay, anticipating this, the forms find vertical integration more profitable. This because vertically integrated forms internalization of the downstream payoffs mitigates the model hazard problem and stimulates upstream investment at a lower social cost. Okay, and I also would like to explain how to find the alpha star. Okay, as the expected transfer decreases in alpha, so both curves, they are decreasing in alpha. Okay, the optimal degree of regulatory risk is determined by the highest probability of regulatory enforcement, such that low effort will be only provided under vertical separation, which means we simply find this crossing point between the EHT VSR and delta nu times delta S. So it's this. So this is why we can determine the value of alpha star. Okay, summarize. Our paper provides a theoretical support for regulatory structures that allows for some regulatory risks. And according to this table, the investment is relatively large, or rather large, for electricity, and takes intermediate values for airports, telecommunications, and rail, and is relatively small for water. And in light of our result that the regulatory risk is optimal in sectors characterized by intermediate investment costs, we suggest that some level of regulatory risk is likely to be welfare enhancing in the sectors such as airports, telecommunications, and rail. Okay? And our paper delivers results consistent with empirical evidence that regulatory risk is not necessarily an impediment of firms' investment, and it can simulate further empirical investment about regulatory risk by endogenizing the vertical integration decision, and it complements the recent findings about the social benefits of regulatory and legal uncertainty. Okay. Thank you very much. So Daniel,
Lovely.
I finished.
Thank you very much.
Thank you.
We've had a number of questions come through. Would you like me to start going through the questions? I think we've got 5 or 6 already.
Okay, thanks a lot. Please start.
Lovely. Okay, so the first question is, what do you believe were the key social benefits that you found as a result of regulatory policy integration after the vertical structure had been established?
Sorry, I'm doing theory, but I try my best to link this with our real life. Okay, so for example, the first idea pop up in my mind is that when we consider the mergers, whatever horizontal merger or vertical merger, it always involves in the efficiency gains, right? So the efficiency gains is always good. And actually, okay, here I didn't present, but in our paper, the extension part, we also discussed verbally about the efficiency gains. And we do believe that even we add the efficiency gains in our paper, our result, the qualitative results do not change. So it's still that the under some situations, under some situations, the optimal result is not a full commitment. So here we somehow consider that the vertical integration somehow plays a role that it can mitigate the model hazard problem, which produced by the regulatory risks. Okay, but without that, of course, there are some other papers talking about this, but the settings are completely different. Yeah.
Lovely, thank you very much. Okay, so the next question we've had is, do you believe that regulatory risk could make vertical integration unprofitable?
Could you please repeat the question?
Of course, sorry. Can regulatory risk make vertical integration unprofitable?
Yes.
Thank you.
Wait, let me come back. here. So, okay, here I focus on the first case, which shows that the regulatory risk is optimal. Okay, but for example, in this case, actually, it's the same as the last case under full commitment, is that if the investment effort is low, actually, both the firms and the regulator, they do not care about the industry structure. So we how to say? So, okay, let me play a trick. So at least shows that the vertical integration is not more attractive than vertical separation. Okay.
Yeah, I think that answers the question. It is a it was, I think the way it was worded made it quite difficult. I think it's the person's really asking if regulatory risk can make vertical integration unprofitable, how does that sort of play out? And I think that you absolutely answered that.
Actually, the regulator cannot make the decisions on industry structure. The regulator actually, according to the laws, the regulator simply shouldn't make this decision. So whether the firms would like to have the vertical integration or vertical separation, this should be the firm's behavior. So then the firms, they only care about their utility. Okay, as long as their utility is higher and a particular industry structure, then they do that.
Thank you. I think the next question is a point of clarification. So they're just asking, how do you measure and calculate the alpha value for the commitment between 1 and 0?
Very good question. So let me answer this question from 3 points. Let me first create this. So actually, we found that the Marsh insurance company, actually they had, sorry. Okay, can you see my website?
Yes, we can.
Okay, good. So first, I would like to say that some companies, they calculate the political risk index. And I don't know, for example, here, if we click Japan, then we can see the number of the index. Okay, the full point is 100. And here, among those political risk, then there are also long-term economic risk index and short-term economic risk index. Okay, and then we can see, for example, I don't know, Italy, then we can see this index is lower than Japan. So which means in Italy it's more risky than Japan. Okay, so somehow we can link this to say that, okay, when we consider this economic risk, is of course they covered more broad area, okay, but anyway, it's also somehow show some flavor in the regulatory industries. But the second point, I have to confess that yes, you're right that actually so far there's no risk index based on the particular regulatory regimes. Okay, so but this is exactly what we suggest. We hope our paper can stimulate further empirical investigation. Okay, but a nice thing is that, so here from this table, what we said is that, okay, the telecommunications, if we consider the investment in the telecommunications industry, actually it belongs to the intermediate level. And according to our theoretical paper suggestion, this industry should allow for some regulatory risks. And if we come back to this investment cost recovery, as what I explained before, is that in US and the German telecommunication industry, actually the regulator use a replacement cost, which means with a higher risk. So at least in some countries, some industries, our theoretical result is consistent with what they are doing now. But I want to emphasize again, yeah, so far there's no empirical paper talking about the index of the regulatory regimes. Yeah, but our theoretical paper simply provide some explanations, but not the more practical things. Thank you.
Lovely, thank you very much. Okay, the next question is, how do you see the practical application of your research main results impacting your local economy and society?
I think my previous answer covered somehow of this question, but I would like to say something more. So, for example, here we also mentioned that if the regulator use the regulatory hearing days, then it brings to the regulated form higher risk. Okay, and in this, so I don't know about other countries, but I know that in UK, if we focus on the water industry, generally speaking, the regulatory policy cycle is 8 years. But after every 4 years, they have this kind of regulatory hearing days, okay? And once that time, because the consumers complain too much, so actually it's linked with the last reason. Then after this kind of hearing days, the regulator changed the regulatory policy. Okay, so but if we consider the very end, this table, according to our paper, the water industry shouldn't at least we do not suggest that the regulator in water industry involves in this kind of regulatory risks. So I think our paper somehow try to explain some existing phenomenon, for example, telecommunications in US and in Germany, and also could provide some insight to the policy makers, for example, the water industry in UK. Yeah. I hope my explanation are okay.
Absolutely, I believe so. If the person that asked it would like any more, feel free to pop another question into the questions box, and we can explore this a little bit further. We've got a little bit of time for a few more questions. If anyone has any questions, please pop them in the question box, and I'll try and get through as many of them as I can before the end. We've had another question. The next one is, can you provide any tangible examples of how regulatory risk has stimulated high upstream investment at a lower social cost? And if so, how can this social cost be measured?
So actually, I think let me think. So here is that because here in the main parts of the model, we consider that T is the transfer from the regulator to the upstream form. Okay, so it's somehow we can interpret this kind of T as a social cost of public funds due to the distortionary taxation, these kind of things. Then actually this does not depends on the investment effort, because the investment effort is unobservable by the regulator. Okay, only the forms they know. So these values of T depends on the outcome. So if this project is successful, I provide the T upper bar. Otherwise, I provide the lower value, for example, T lower bar. Okay, so yeah, so how to say, if we consider the standard model hardware problem, then whatever the transport or the price, it cannot be made by the regulator or principle based on any unobservable variables. It's only based on the observable outcome. But of course, if the form provides a high effort, okay, then of course the probability that the outcome is successful is higher than the case that the form provides the low effort.
Lovely, thank you very much. I think you've answered everyone's questions. We can wrap up the webinar now. I just want to say once again, Dr. Guo, thank you so much for taking the time to speak to us today, for a fantastic presentation, for such in-depth research, and for answering all the questions and really looking at the practical applications of what the theory behind the research actually means. So I've really enjoyed this morning. Thank you very much. Thank you everyone for sending in questions. It's a pleasure. Thank you very much. And thank you everyone for sending in your questions. Just to remind everyone listening today, we'll make the recording available after the webinar, and we'll send you a copy of that via email in about a week from now. So if you want to refresh your memory, that will all be there. But once again, thank you once again, Dr. Guo. Thank you once again, everyone, for listening. And that concludes the webinar. Thank you.
Thank you.